This is the Future of Finance.
Hi everyone, welcome to the Future of Finance podcast. I'm George Dyer, and today we're discussing carbon markets and if they might just be one of the most powerful tools in the fight against climate change. Today's guest, Mike Azlen, believes that they can be, and he's built a business to prove it. Mike is the founder and CEO of Carbon Cap Management, an investment firm focused on reducing carbon emissions through market-based solutions. With decades of experience in asset management and a successful career, he shifted to focus on climate change and carbon markets through Carbon Cap's World Carbon Fund. He and his team are showing how investors can drive positive impact while generating returns. In the episode, we dive into how carbon markets work and why they matter, the role of institutional investors in climate solutions, and what's next for the rapidly evolving carbon pricing landscape. As we've discussed in other episodes, addressing externalities and accounting for the true costs of our activities is essential for creating sustainable and regenerative economies. And carbon markets are one of our best tools for doing just that, at least for climate change. So I hope you enjoy the show and pass it on to others who might as well. Let's dive in. Hi, Mike. Thanks for being here today. Great to see you again. How you doing?
Very good. Very good. Good to be here, George.
Excellent. Excellent. Well, I'm really excited to share your story. And I always love these stories where investment experts start working in climate and on sustainability. So I'd love to hear a little bit about just how that process went for you and what got you started on focusing on climate and starting Carbon Cap.
Sure. I'll give a brief sketch of my background. Undergraduate degree in Canada. I'm Canadian, and then I did my graduate degree in London at London Business School. I worked as a proprietary trader for two Canadian banks, and then I worked in the hedge fund industry in London, England for a number of years before setting up my first investment management company in 2005. I was fortunate, George, to grow that business and ended up selling the company to a Swiss public company. And it was after that exit event that I took stock and began to research the science of climate change. This was about 1 year before Greta Thunberg kind of burst onto the climate change scene. And I'm a very empirically driven person. So when I research something, I usually go to peer-reviewed academic research. And that's where I began, somewhat skeptically, I must admit, with regard to climate change. I had two fundamental questions. One was, how acute really is the problem? And in terms of temperature rise and CO2 concentration. And secondly, was it definitely an anthropogenic phenomenon, or is this a natural phenomenon? I was aware that the planetary cycles had changed over millions of years due to perturbances in the orbit of the Earth, etc. Having reviewed now more than 200 peer-reviewed scientific papers, I can say with great confidence that anyone who has, like in our industry, a scientific, empirically driven mind, I think would come to the same conclusion I have come to. Number one, the problem is extremely acute, far worse than even many people who work in the climate change space realize. And number two, it is most definitely anthropogenic, meaning it's human beings that are causing this. Having done that, I decided to spend time thinking my next business, I'd like to do something in this space. I enrolled at the LSE, another esteemed institute here in London, London School of Economics, and they have a high-level program on climate change. And I learned many things in this program, but that is where I was first exposed to carbon markets as a policy mechanism to address climate change. And once I understood the mechanism, I, of course, looked at the market, and I was amazed to see carbon was a liquid asset class. It was trading at that time about $10 billion US per month. And that was incredible to me. This is a liquid asset class, very unique asset class. My first question was, I wonder what the statistical properties of carbon are, historical return and volatility and correlation. These are the basic questions that most investment professionals would ask. When I looked for research to answer those questions, there was none. So I hired a PhD student, myself, from the LSE, and together we collected and built a proper time series database for each carbon market. That took about 4 months. And then we analyzed it and we wrote a complete academic paper. And that paper we submitted for journal publication. It took 3 years in the peer review process, but it was published in the Journal of Alternative Investments in 2022. And really the data and the paper served as the foundation for Carbon Cap, my second asset management business today. So off the back of that, we developed a quite quantitative and fundamentally driven investment strategy to invest into these liquid carbon markets. We launched the fund 5 years ago. And George, we wanted to bring an impact element to what we were doing. This was my second business at a later stage in my career. And we decided to align the interest of investors and the manager around both performance and climate impact. And the way we have achieved that is that 20% of the performance fee element that we charge, so we charge a management fee and a performance fee, 20% of that performance fee, which is normally crystallized at the end of each calendar year, will be put towards direct climate impact activities. And I'm very pleased to say that the fund has now completed 5 years of track record. The fund has grown to over $500 million in size, and it's generated a return over that period of approximately 125% net of fees for our clients. So it's been very successful. That has also thrown off quite a nice sum into the impact side as we crystallize each year. And thus far, we have used that impact allocation, which has been about, I think, 1.7 million US in total. We've used that to purchase regulated carbon permits and to cancel them. And I think in total now we've canceled about 33,000 tons of regulated carbon permits. If listeners know, there's a big difference between compliance regulated markets and, of course, the voluntary market. So we now are 11 people in London managing this fund. We have last year we onboarded 4 institutions and our first sovereign wealth fund. So the business is growing nicely, and you know, it's quite nice to know that at this size now, if we really continue to perform, we will be creating quite a big climate impact piece. And our plan is to diversify that spend into a more diverse portfolio of climate impact activities as the quantum grows.
That's great. That's great. And I want to get into more details on the fund, but first, just so refreshing and exciting to hear you dive into the science. I mean, so few people really do that, and it is, well, it's frightening, frankly, but I think it's also compelling to really look at, as you say, how acute the challenge is. And I think also it's just a testament to why it's so important for investors to really look at this and focus on it, because I think, as you say, investors tend to be fairly rational and clear-eyed about these things. And can kind of, good ones anyways, cut through the noise and the politics and see what's really at stake. And I think most that do that, as you say, find that climate risk is real financial risk and also opportunity there. So I want to get into more of that. But first, maybe just, you alluded a bit to the carbon markets and sort of the voluntary versus compliance. So can you just give a quick overview of the basics on how carbon markets work and then how that translates into, investment activities?
It is somewhat of a complex topic, but I find it very intellectually stimulating. So if listeners are interested, I would recommend for them to go to our website, and we have a lot of short educational videos, and of course our research paper is also open access. Effectively, there are 2 carbon markets that exist in the world currently, George. We have the regulated carbon markets. Examples of that would be the European emission trading system, the UK emission trading system, and the California cap and trade system. And then we have voluntary carbon markets. And I always characterize these 2 markets. They're extremely different. And I cover really 5 key characteristics. So when we talk about the regulated markets, the first thing is they are highly regulated. They are run by governments with the objective of capping and lowering emissions in that geographic region. They're very large in size. They're liquid. I mentioned at the beginning of our research, 10 billion per month was the traded value. That has increased now to 60 billion per month. They're very transparent. Because it's run by the government, all of the rules are disclosed by the government. And the 5th point, in regulated carbon markets, the means by which it achieves its objective of lowering emissions is by reducing each year the supply of permits. It's reduced each year, forcing abatement activity. If we move the lens to the voluntary carbon markets, it's quite different. The first point, regulation, there is little to no regulation on this market. It is amazing to me in this day and age of very tight regulation to have a financial numismatic asset, a carbon credit or offset, and that is the term in the voluntary market, with no financial oversight and regulation. Number two, the market is illiquid. It's not a liquid market like regulated. Number three, it's very small. And to give listeners a sense of the size differential, if one were to look in the last 3 years, on average, the regulated markets have traded about $1 trillion US per year, and the voluntary markets have done around 1 billion. So this is approximately a 1,000 times differential between these two markets. So it's quite significant. Point four, the methodologies are very complex and opaque. It's very difficult to understand how they've calculated the credits that are generated. And point five, which I think is really the most important, in the voluntary market, there is virtually an unlimited supply of these credits and offsets. And that, of course, in any commodity where there's an overabundance of supply, it leads to low prices. And low prices lead to, unfortunately, negative effects. In other words, instead of cutting my emissions, I may choose to buy a very low-priced offset, and unfortunately, that action may, in fact, exacerbate climate change. So there's a lot more to it than that, but we are only involved in the regulated liquid carbon markets run by governments and not involved at all. And we recommend to all of our clients to steer well clear of being involved in the voluntary carbon market due to large financial losses that have been incurred by, unfortunately, a number of investors.
That's helpful. And so putting voluntary markets aside for a minute and focusing on the compliance market, as you mentioned, there's a cap. So there's a limit to how many emissions can happen in that jurisdiction. And then the government allocates permits to companies, right? And then those companies can trade those permits if they need to buy permits because they're emitting more or they're emitting less, they can sell those permits. And then investors can jump into that trading, right? And buy and sell those credits. So what is, I guess for institutional investors in particular, why should they consider that? And kind of what are the main risks and opportunities in doing so?
Yeah, I mean, maybe I could just share my screen for a moment and share some information. Mm-hmm. Hopefully because often a picture is worth 1,000 words.
Yeah. And for our listeners, you can catch this on YouTube. So there we go. Go ahead.
Yep. I'll just go to a full screen here, hopefully. I mean, in our research, this was quite fascinating in terms of most investors want to know what I did at the beginning of the research, which is, what does this asset class look like in terms of its properties? And I'll just give you some data here. We've just updated this to the end of 2024. I've listed 4 carbon markets here, George. Europe, New Zealand, California, and the RGGI market, which is on the east coast of the United States. So there are actually 3 markets that are active in the United States. And you can see over the last 11 years, all of these markets have produced quite attractive annualized rates of return with quite high but varied volatility. When we look at the last 4 years, and now I've added the UK carbon market, which just launched about 4 years ago, you can see that these carbon markets are really not correlated at all to each other. And that stems from a lack of fungibility. So each carbon market is run by the government in California or the government in Europe, and the actual allowance permits, and that's the term that we use in these regulated markets. We don't use the term offset or carbon credit. That's the voluntary market. These carbon allowance permits are not fungible between the markets. So they're all driven by their unique supply and demand characteristics, which means they're not correlated to each other, but they all have produced historically very attractive rates of return. The other interesting thing is to look at correlation. So here I've graphed the 90-day rolling correlation to the U.S. stock market. And again, it varies between 20% and minus 20%. It's effectively zero. So you have an asset class that is liquid, has a positive rate of return, and no correlation to the main equity asset class globally. that's a recipe for something that could be attractive in your portfolio. Moreover, coming back to that point, the cross correlation between the individual markets is also effectively zero. So by diversifying your portfolio across multiple carbon markets, your overall portfolio volatility, of course, is substantially reduced. Your risk goes down substantially, but not necessarily your return. And that when we found this was somewhat surprising to us in our research, and it was one of the big drivers of why we wanted to launch the world's first multi-market carbon fund. And in terms of maybe, George, just covering the markets, so listeners know we're currently invested today in 5 markets. Europe, and then the UK. The UK, of course, launched after Brexit. The California market, which has been a market established in 2012. The RGGI carbon market, which is 10 states on the east coast of the US that are in one carbon market. And that's market number 4. And market number 5 is New Zealand. So those are the existing markets. But what is very exciting is all of the new carbon markets around the world. So China and Korea have already launched. Japan is launching next year. Mexico is running their pilot. Brazil and India have both announced they will launch. And all of the Asian tigers. There's probably 10 countries. So that asset class has gone from that 10 billion per month to 60 billion, and we see 200 to 300 billion per month in 3 to 5 years.
Wow. Yeah, I had not been following that. I didn't know all those new markets were planned. And how long, do you see this coming eventually into a fungible global market? How long do you think that might take?
Yeah, definitely. So the whole purpose of carbon markets is indeed to link, because if you have 2 carbon markets, because carbon markets stimulate what I always say are the 3 magic words. We want to reduce emissions, but we want to reduce emissions at the lowest possible cost. And the reduction of emissions, we use the word abatement, to abate meaning to halt or to stop. And the 3 magic words are least cost abatement. We don't want to force companies to reduce emissions and it costs so much they go bankrupt. What we want to pick the lowest hanging fruit, and that is exactly how a carbon market works. And therefore, if we have 2 carbon markets, only in one market there will be a company that has the lowest cost of abatement. And therefore, once we link those markets, that linked market is now tapping in to that least cost abatement source. And so there's great advantages to linking. Switzerland had their own separate carbon market, and then about 4 years ago they linked with the European market as an example. So I think timing is difficult, George. I think what we'll see is regional markets. So North American markets and maybe South American markets may link as a regional. Then you might have multiple sort of Europe and Middle Eastern markets link, and then Asian markets. And then perhaps it's very difficult to forecast, 10 to 15 years, we could have then global linkage and one global carbon price.
Mm-hmm, mm-hmm. Yeah, it's a great point to underscore about it's really leveraging the efficiency of the markets to find the least cost paths to decarbonization. And I think, as you talk about that, obviously, like all markets, but this market is dependent on policy and sort of guidelines that are set by lawmakers and regulators. So what are you watching most closely in that, I guess, in any of the markets or globally? And just in light of, sort of some of the recent elections and governments that might be turning on climate, how big a risk do you think that is to some of these markets in the next few years?
Yeah, this question comes up often. The first thing to say is because these are regulated markets and effectively markets created by the government to address emissions, they are very sensitive to policy changes. And I can give you a number of good examples of that. Currently, certainly there's a somewhat of a negative outlook for ESG and climate, obviously, with the new Trump administration. However, ironically, some of the policies in the Trump administration are bullish for carbon prices in the United States. And again, I could go through some specific examples. When you study the historic volatility of returns in this asset class in particular, like many other commodities, the asset class has kurtosis or fat tails. So there are a larger number than normal big up months and big down months in this asset class. And a large proportion of those, George, can be linked to some kind of policy announcement, both a move up in these carbon markets and a move down. So it's vitally important, firstly, to mitigate this policy-related risk. Your first port of call is simply diversification, because while all 5 markets are sensitive to policy, the policy issues, of course, in New Zealand are completely different to those in California. So simply by diversifying, you've already significantly mitigated this policy risk. And then the second strategy there is, as you pointed out, you have to intimately follow the policy developments in each market. And as they change, you have to incorporate that into your investment approach in each market. And a good example was the UK. When the UK carbon market was created after Brexit 4+ years ago, there was a lot of green outlook for the UK at that time. They were seen as a green leader. And the UK carbon market, after it launched, it traded to a premium to the European market. Then we had the Liz Truss government fiasco. Then we had Rishi Sunak and the Conservative Party, and they began to backpedal on general climate change commitments. And when the market began to get a sense of this, the UK carbon price really began to sell off. We went from a long position in that market to being flat. We got out, and then we actually went short the market. And in that year, it finished the year down 42%, and we actually made money in the fund. So that's one example, but there's many more where you do need to track these policy developments.
Mm-hmm. Yeah, that's a great point. And so it's kind of speaking about the investment structures for those, for endowments and foundations, the type of institutions in our intentional endowments network that might want to get into this. What does that look like? I mean, you mentioned these markets are very liquid, but in terms of institutional investors, the World Carbon Fund is the vehicle that Carbon Cap has to implement this. Is that right? And just talk a little bit about how that works. Are there minimums? And what's the kind of structure?
Yeah. So one of the things that I think we are encountering with more and more institutions, and I think it's classic due diligence, is institutions normally go through a sort of 3-step process. The first step is, because many have not heard of the asset class, they want to understand kind of the statistical properties of the asset class as we went through, and then they want to look at the liquidity of the asset class. One of the unique things many clients ask is, well, if I just bought and held carbon, what would be my potential passive return? And indeed, there are some carbon ETFs that are in the marketplace. And in fact, this was the thrust of our academic paper. Because commodities and commodity futures, which is where all the liquidity lies in carbon markets, academically speaking, many academics would say that commodities have no forward-looking return, no risk premium per se, and because they don't produce any cash flow like dividends or coupons, which equities and fixed income do. So, but of course, the carbon market operates with one very important principle. The supply is reduced by the government each year, and each of the underlying companies, they must buy permits that match their emissions. So if you are running a factory in the state of California and you emit 2 million tons of carbon per year, you must buy 2 million permits and give them to the government every year because the government audits you. And so that CEO is very focused on 2 prices, not just the price of the permit. The permit currently in California is $32. If the second price that CEO is looking at is their internal price. And when the permit price rises above their internal cost, instead of buying the permit, they simply cut their emissions. They invest capital to restructure the factory floor and reduce emissions. And so these are the 2 dynamics of how the carbon market harnesses really the profit motive of corporates. It harnesses the profit motive to achieve those 3 magic words, the least cost abatement. And this is a very good example of that in this graph. It's a very famous graph, the marginal abatement cost curve, which has the price per ton of carbon dioxide here, and then all the emissions in California, let's say 180 million tons. And for some companies, the top of the bar is their cost to cut. This is their abatement cost, $10 a ton. But some companies, it's $200 per ton. And if the permit price was 50, George, the way an economist would look at this is we would say all of these companies where their internal cost is above 50, they, of course, because they're profit motivated, they will choose to cut their emissions instead of buying the permit and giving the money to the state of California. So this is the dynamic that is operating, and it's a very, I think, powerful dynamic, harnessing the price. And therefore, with supply declining, there's this relationship that in order for the market to achieve its objective, lower emissions, the only way that happens is if the price goes up. Every time the carbon price goes up, someone within the ecosystem cuts their emissions instead of buying the permit. Then the price goes up, and we effectively climb the ladder of this marginal abatement cost curve over time. And that's why we and many others believe this asset class, even though it's a commodity, it does indeed have a forward-looking risk premium. How big? Well, we did an analysis of very well-respected studies, and they're listed here, where it's estimated, Bank of England, the IEA, that the price we need in 2030 to be consistent with the Paris Agreement is about $120 a ton. And what we then did is built an index and said, where is the price? And this is very interesting. These are the 5 markets that we invest into. And you can see it begins at around $25 per ton. It had very good performance in 2020, very big return in 2021. Carbon prices really advanced. Our fund was up more than 50% that year. But in the subsequent 3 years, we had a negative year in 22. Carbon prices dropped again in 2023 and dropped again last year in 2024. I would add that our fund was positive in all 3 of those years. But I think the key point here is, what is the passive return? If I buy at 55, if the price reaches 120 by 2030, this yields an 8.8% annual risk premium. And of course, being a risk premium, that is in excess of the risk-free rate. And at the time we did this calculation, which was year-end, 6-year treasuries in the United States were around 4.4%. So passive investment in this asset class has about a 13% annualized expected rate of return. And I submit to you, having traded convertible bond arb and merger arb and many strategies that have a tailwind, that this is one of the most powerful tailwind asset classes. So I think you can make a very strong argument for a passive exposure. Obviously, it doesn't go up every year. The last 3 years have been negative, and that is why we would, of course, advocate for an exposure in our fund. We've significantly outperformed this index. But I think that this is a very important lens in which to think about the asset class for an institution.
Mm-hmm. That's really interesting that even on the passive side, there's that expectation. And just to put a finer point on what you were saying, because you're actively managing it, you can, buy, sell, go short when you see these policy expectations change or dynamics change in these different markets. That's great. And so I'm curious also, a lot of endowments and foundations have made net zero portfolio commitments and are looking at the carbon footprint of their portfolio, as well as sort of the broader systemic impact on climate that their investing has. So how does this relate to those goals? And is that something that your investors look at or talk to you about very much?
Yeah, definitely. So the first thing to say is all the policymakers involved in carbon markets and participants clearly understand this key relationship. A higher price means lower emissions. And that is what we are all seeking as environmentally, facing individuals, whether an endowment or just an individual. And so all the participants want the same thing, a higher carbon price. So when you are long carbon, you buy carbon and hold it, passively even, you're aligning yourself with the policymakers, and we see it as a very green investment in the portfolio, even as a passive investment. In addition to that, our fund, of course, we have this built-in commitment within the fund prospectus where 20% of the annual performance fees will be used to purchase and cancel regulated carbon permits, which increases the impact. And partially for that reason, George, The fund is an Article 9 fund under the SFDR Article 9 nomenclature under the SFDR in Europe. So Article 9 is the highest form of impact, and yet our fund, of course, because the instruments we trade have daily liquidity, and we only hold three instruments, futures, options, and the physical permits, our fund has monthly liquidity. So, the combination of hard and soft impacts with monthly liquidity makes our fund a liquid impact fund, which is quite unique. Most impact funds, as you know, will be, of course, private equity.
That's great. No, it's fascinating. Well, Mike, I can't believe it, but our time is running short here. So just a couple of final questions that we ask of all our guests. And the first is, given this and your views on carbon markets and the need to kind of internalize these external costs, what's your vision for the future of finance?
I would say one of the most important things about emission trading systems is their huge success. The European emission trading system is the longest standing. Since it was implemented in 2005, emissions in Europe have dropped 1 billion tons per year on an annual run rate basis. That, in a world of 40 gigatons of total emissions, 1 billion reduction is moving the needle. So the academic research also confirms this, that emission trading systems have been by far the single most successful climate policy instrument that has ever been rolled out. And so I certainly, and it's one of my personal objectives, to educate policymakers, particularly in emerging market countries, when they submit an NDC commitment under the Paris Agreement. And then they're thinking, how will we reach this NDC commitment? Do we put a carbon tax, a carbon market, other environmental policies? I think that the success now of a 20-year success story in the European emission trading system, and more than 10 years in California, I'm hopeful that more countries will launch carbon markets. One of the reasons is because they are one of the few mechanisms that can lower emissions at the scale required with the very short window of time we have left to address the climate crisis. If China, which has launched the largest carbon market in the world, covers 6 billion tons annual emissions. If they reduce that in the linear cap reduction, which is typical in these markets, by 4% a year, 4% of 6 billion is 240 million tons per year. That is the entire emissions of the UK being taken out of the system. So, if you imagine India, Brazil, and China, these big emitting emerging countries, capping and lowering their emissions, it could be really impactful. And that is one of my hopes, that emissions trading will proliferate as fast as possible.
And I was going to ask you about sort of a call to action, but I think you touched on it there. I mean, for investors to help make that happen, you think educating policymakers, engaging with policymakers is the most impactful thing they can do right now?
I think education is the huge factor. I think the amount of misallocation of resources in terms of climate impact and philanthropy should be directed much more towards education and awareness of emission trading systems, how they operate, how they function, and how they can be customized for each country, because there's a lot of levers. When the government sells the permits, for instance, in California, this generates billions of revenues to the government in California. All of that revenue is segregated and reinvested into energy efficiency and low carbon initiatives. So you have a policy here that's extremely well designed. It has primary benefits, capping and trading, secondary benefits, least cost abatement, and then tertiary benefits, the recycling of those permit sale proceeds, those auction proceeds, into lowering emissions again. It really is a smart mechanism. So I think there needs to be a greater emphasis on educating policymakers globally about this mechanism, and then hopefully encouraging them to roll it out.
Well put. Well, speaking of education, the final question here is for college students or young people looking to get involved in this field, to have this impact, that are interested in finance. What kind of advice would you give them?
I hope listeners can see how passionate I am about this particular topic. My advice is to try and find something that you have a natural affinity to, that you're good at, and then marry that with something that you enjoy. Often those go together, but not always, so that you have then something you're passionate and good at together. Then when you're working, it really isn't work, is it? You're doing something that is truly aligned with what you're doing. And the earlier, the younger you can find that, I think then it puts you in a great position.
Excellent. Well, Mike, thank you again. This is such a great conversation. I always learn so much from you. So really appreciate you taking the time. And I look forward to talking again soon.
Thanks very much. And as I said, be happy to engage with any endowments about the fund. And we have a lot of material on our website, carboncap.com.
Wonderful. Yeah, we'll put that in the show notes. Great. Thanks,
okay.
Mike. Bye-bye.
Okay, thanks. Bye-bye.
Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.